Are you a parent who wants to give your child a financial head start? Well, you are in the right place. Welcome to Beyond Piggy Banks. I'm George, and in each episode we explore simple, practical ways to shape your child's financial future. And the best part, you don't need a financial degree, and you don't need a lot of money to begin. The earlier you act, the bigger their advantage becomes. Let's build their future. In the last two episodes, we met the dangers: ourselves, inflation, and fees. We learned to recognize our own emotional traps before they cost us. We understood how inflation quietly erodes money that sits still. And we saw, in real numbers, how fees compound against us the same way returns compound for you. The dangers are named, the defenses are in place. Now we build. Today, we take the first concrete step toward creating a portfolio. And it begins with understanding the two types of investing you will choose between. We touched on this briefly in the last episode: passive and active investing. We understood that both come with a financial cost. Today we go deeper, because this choice is not just about fees. It shapes everything. Active investing is built on a single belief: that with enough skill, research, and judgment, you can beat the market. It is exactly what it sounds like. A professional fund manager or a team of them actively manages your portfolio. They research companies, analyze markets, time their decisions, buy and sell constantly. The goal is simple: beat the market. And beating the market just means growing your portfolio faster than the overall market grows. If the market returns 7% and your fund returns 10%, your manager beat the market. That sounds appealing. Of course you want someone working hard to get you more. But here is what most people never see clearly. Every decision an active manager makes has a cost. Every trade they execute generates a transaction fee. Every position they hold may trigger a tax event. And on top of all of that, they charge you a management fee for their time and expertise, regardless of whether they beat the market or not. So, before your money grows by a single cent, it is already carrying a weight of cost that passive investing simply does not have. Passive investing came later, and it was born from a very different proposition. In 1972, a university professor named Burton published a book arguing that investors would achieve better results simply by buying and holding a diversified portfolio, rather than trying to beat the market. The idea was radical at the time. Stop trying to win, own everything, let the market work. That idea inspired Jack Bogle, founder of Vanguard, which is one of the largest investment firms in the world, to create the first index fund. An index fund simply tracks the entire market. No manager picking winners, no constant trading, just own it all at the lowest possible cost. He launched it with just $11 million in assets. Today, as of 2025, for the first time in history, passive investment has overtaken active investment in the United States. Globally, it still only represents around 29% of assets, but the direction of travel is clear. And the reason is not complicated. 80% of professional fund managers, yes, 80%, people with teams, research departments, decades of experience, and every possible advantage, still fail to consistently beat the market over 10 years. 80%. And they charge you for the privilege of trying. I could give you more numbers, but instead let me tell you an interesting story. In 2007, Warren Buffett, one of the most successful investors in history, made a public challenge to the entire hedge fund industry. He offered to bet $1 million that a simple low-cost S&P 500 index fund would outperform any collection of actively managed hedge funds for the next 10 years. Now, a quick note on what the S&P 500 actually is. It stands for Standard & Poor's 500, which is a collection of the 500 largest publicly traded companies in the United States. Companies like Apple, Microsoft, Amazon, and Johnson & Johnson. When you invest in an S&P 500 index fund, you're not picking one company. You are owning a small piece of all of them at once, all 500 of them. It is one of the most diversified and widely followed benchmarks in the world, and it costs almost nothing to own. Back to the bet. He expected silence, and that is largely what he got. Thousands of professional fund managers, people who had built fortunes telling clients they could beat the market, said nothing. One man stepped forward, Ted of Protégé Partners. He picked up 5 funds, each of which invested in dozens of hedge funds, representing over 100 active managers in total, the best he could find. The bet officially began on January 1st, 2008. The first year looked good for the hedge funds. Markets crashed in 2008, and the active managers, with their ability to move quickly, lost less than the index. It seemed like their skill was showing. Then the roof fell in. In every single subsequent year, the S&P 500 index fund outperformed, year after year after year, consistently, quietly, without a single human decision being made. By the end of 2017, the result was not even close. The S&P 500 index fund delivered a total gain of 125.8% over 1 decade. The 5 hedge funds average gains of 21.7, 42.3, 87.7, not bad, 2.8% and 27%. During those 10 years, the active managers made thousands of trades. They studied financial statements. They spoke to corporate management teams. They employed analysts. They worked. The index fund did nothing. It just owned the markets and waited. And then Buffett said something that belongs on the wall of every investor's office. Performance comes, performance goes. Fees never falter. Who also won the bet was the charity Girls Inc. of Omaha. They received a check for $2.2 million. Buffett donated his winnings. The bet had grown beyond its original value because even the collateral, invested quietly in the market, had compounded beautifully. So, which one do we choose? Both approaches exist for a reason. Active investing has its place. There are markets, moments, and specific asset classes where skilled managers do add value. That is a conversation worth having, at least. But for what we are building here, which is a long-term engine for your child's financial future, running quietly in the background for 18, 20, 25 years, the answer is clear. We choose passive. Not because it's the easiest option. It's because the evidence consistently points in one direction. Lower costs, broader diversification, less interference from human emotion and decision making. And, as we just saw, even the greatest investors in the world struggle to beat it over time. The engine we are building is designed to be consistent, automated, and resilient. Passive investing is not just compatible with that system, it is the foundation of it. This does not mean you will never encounter active elements. Some markets, some regions, some asset classes may call for a different approach, as I said. But the core, the backbone of your child's portfolio will be passive. Simple, low-cost, patient, and working every single day while you get on with your life. The choice is made. But choosing passive is only the beginning. Knowing that you want to own the market is one thing. Knowing what to actually put in your portfolio, that is the next question. And that is exactly where we are going. In the next episode, we will talk about assets, what they are, what each one does, and what kind of risk each one carries. Stocks, bonds, real estate, commodities. Each one explained simply, no jargon, no products yet, just the ingredients before the recipe. Because before you can build a portfolio, you need to understand what you are building it with. I'm George, and I'm here because your child deserves the advantage we never had. We are done hoping for the best, we are building it. Subscribe to Beyond Piggy Banks on Spotify, Apple Podcasts, or wherever you listen. The clock is ticking. Let's get to work.